Hello and welcome to another episode of Fractional Impact. Today we're speaking to Tony Meadows about why operational discipline matters more than ever in venture capital, what limited partners actually want to see in reporting, governance, and fund management, and how new managers can stand out in an increasingly crowded field. Tony, would you like to introduce yourself?
Yeah, thanks for having me, Stuart. Finn, good to meet you guys. So I'm a CPA by training. I spent a good 7 years at a CPA firm here in Harrisburg, Pennsylvania. Then I spent the next 14 years at a defined benefit plan, Pennsylvania Pacers, based again here in Harrisburg, Pennsylvania, where I helped deploy about $2 billion of capital between primary fund as well as co-investments. And then in 2024, I worked at a VC fund-to-fund that was focused on investing in women-led and co-led venture capital firms. During 2024, I met over 320 firms and got a good perspective on the addressable market out there.
Awesome. And we're joined as usual by Finn Patrick. If you'd like to introduce yourself, Finn.
Yeah, thank you, Stuart. My name's Finn. I'm a fractional executive of 10 years now, and I'm really excited to have Tony on the show. VC and PE is a big part of the work that I do, and I'm really interested to kind of collaborate and learn from others as well. So, Tony, really excited to have you on today.
Excited to be here. Thank you.
Tell us a bit more about what you've been up to over the last few years. I know your career has evolved through a few different spaces, public pensions, accounting, venture capital. How did you get to where you are at the moment?
Yeah, it's a great question. I didn't have a linear path to my career. As I mentioned, I started off as a CPA in public accounting. It was a very good experience in the sense that, when you work for a smaller regional firm, you're doing everything in the audit engagement. So it was very important for me to understand the business operations as well as the financial workflows, and then work on the engagement there, usually an audit or a review engagement, and really seeing how the business is being built. Then I went on to work at Pennsylvania Pacers, where I started off in financial management, really an extension of that CPA experience, where I was overseeing the audit, general ledger. I was essentially the controller of the $70 billion pension plan. And then finally moving over to investments, that CPA experience came into play where I was underwriting co-investments. So we had a program where we were allowed to co-invest alongside general partners that we were investors in. And so oftentimes they would have availability to invest directly in the companies that they were investing in their fund. So underwriting those co-investment opportunities, again, goes back to, the CPA world. And then I kind of went, bottom up going into alternatives, because I started off in, like I said, co-investments, and then I started underwriting fund investments. And so really understanding how general partners underwrite, add value, and source and diligence their investments gave me a different lens into investing in funds themselves. And then finally, last year I spent working for a startup, essentially, that was a venture capital fund-to-fund that was investing in women-led and co-led VC firms. And I got to help build the infrastructure for that. And so I really got to work in that capacity as well. And then meeting, hundreds of venture capital firms and really understanding, the different strategies and the makeups and all the nuts and bolts to all those firms. And it's not hyperbole when I say of those 320 that I met, no two were the same. Everybody does venture capital differently. And it was always interesting to hear different perspectives.
From those 320 venture firms that you met with, what differentiated the good from the bad in your perspective?
Yeah, it's interesting. I mean, I get that question frequently, and oftentimes people are looking for a checklist item. You know, what are the questions I should ask? And those are good starting places. You know, definitely start off with a standard set of questions, but it's really the follow-up questions that really drive you to understand, you know, the general partners themselves, or strategies and things of that nature. And through that process, you really get to understand, you know, who's authentic. I think that's probably the best, you know, biggest trait that I looked for in general partners, and it's really that simple. But it's not something that you can glean from a pitch deck review or looking at their website or things of that nature. You really have to spend the time to meet with the team, perform reference calls, get to know those individuals. And so that's the real secret, you know, is the feeling that you get when you sit down with a general partner. You know, the top general partners exude a level of self-awareness, integrity that you just can't fake, you know, and it's a rare feeling. And it truly separates the best from, you know, from the rest in that category. And anybody can be a great salesperson, but you know, the best general partners are really genuine partners.
Interesting. Can you tell us more about how you're in that position to evaluate over 300 venture firms and what you were evaluating them for, and you know, why you were doing that, and that kind of thing?
Yeah, the as I mentioned, the thesis for that fund to fund was women-led and co-led VC firms, where we felt having that gender diversity led to outsized returns. And so, what you also want to be cognizant of is what, you know, how authentic that mission is for the team themselves. So it takes, again, another level of diligence to understand the financial structure behind that, and the alignment within the firm. So it was just an interesting opportunity, and to be able to again talk to all these different firms, understand the different strategies, and see who's more authentic than the others. Again, like I mentioned, you know, self-awareness and thoughtfulness were some of the key characteristics I was looking for.
Interesting. At one of the companies or funds you've worked with, you allocated around $2 billion, if I'm not mistaken. What kind of lessons did you learn from that scale of capital deployment?
Yeah. You know, with a large pension plan that's, you know, $70 billion, I'm not, you know, I wasn't allocating $10-20 million to funds. And a lot of times when you're writing those big checks, it, you know, it limits your opportunity set. And so that really means that you're really only able to look at the biggest, most established funds out there. The biggest lesson I had was realizing that we were missing out on a lot of early stage venture capital that had more dynamic returns. And they usually came from, again, smaller managers or emerging managers. That also applied to small cap buyout as well as venture capital. And so that experience drives my work today, and the reason why I'm focused on helping institutionalize funds. I want them to be institutional grade as quickly as possible. That shows a different level of sophistication that you can hopefully, you know, get more capital from more sophisticated LPs that are going to be able to write larger checks when you are of that size.
Yeah. Interesting. What kind of role does risk play in terms of risk evaluation and risk management, given that you've been in different sort of investing climates, let's say, with regards to risk? So with the venture capital stuff, obviously, being known as a bit more risky than pension funds and that kind of thing. How do you change your risk evaluation or management, if any, depending on who you're working with and what you're doing?
Yeah, risk, and there's so many different types of risks out there, and what you're looking to do is understand and evaluate each of those risks. You're never able to mitigate all those risks. If you mitigate everything, then it becomes unattractive returns. In particular in venture capital, I think that's the trap that a lot of LPs fall into, is that they want to limit emerging manager risks. They're not able to underwrite a fund one, yet fund ones tend to outperform. So how do you get that exposure to an emerging manager if you're not willing to do it in a fund one? There's the risk that you have with a fund one that leads LPs to not wanting to back them is team dynamic. There is a thesis where teams fall apart, and it happens frequently, and it is a risk that you have to be cognizant of. And if you spend time and understand the team, you'll be able to underwrite them for successive funds because you have a greater a greater understanding of the team dynamics. That is, it's a robust team, that they're going to stay together for 10, 15, 20 years versus a one fund commitment. LPs don't want to, fund a one fund at a time. They want to be able to back a general partner for successive funds. So that's one risk. Other risks, like macro risks, are it's tough to be able to mitigate all that. Venture capital, just like buyout, is a long-term asset class. So there are LPs that will be more tactical with that allocation to alternatives when it should be strategic. It should be long-term steady capital into that asset class, and then you're going to benefit from dislocation, and you're really never going to mitigate a bubble or something like that is going to happen. Again, there's so many different types of risks. All you have to do is be able to evaluate each of those and say, yes, I'm looking to take this risk. But in particular, we're going back with venture capital. Venture capital is a risky asset class, and you have to understand that. And so what is your strategy to allocating to a risky asset class in order to get those outsized returns?
Tony, I'm very curious about risk diversification in terms of, across the whole portfolio. Obviously, every company that is backed by a VC isn't going to be successful. But in your mind, or from your perspective, what's realistic in terms of across the portfolio, what percentage is going to become successful versus the ones that aren't?
From the fund level or the company level?
From the fund level.
From the fund level. So again, I think what you end up having to do is the way that you mitigate that risk, if we're just honing in on venture capital, is that you really have to know the ecosystem. You have to talk to more funds, not fewer funds. So if you have a mechanism where you're artificially whittling down your prospective universe, whether it's pitch deck reviews or just perhaps speaking other limited partners, or you're waiting till they've raised capital, or you're waiting till they're fund 2 or fund 3, you're missing out on that upside. It's too late. So in order to mitigate that risk, you really have to know the entire universe. But going back to my earlier comment about the GPs, there are concentrated bet GPs. There are GPs that are more diversified in their portfolio construction. So understanding that and really looking at their strategy and their sourcing mechanism and just their portfolio construction themselves helps mitigate that. So there's a lot of different tools that you could use in order to understand that. But at the end of the day, you really have to know, just like as a limited partner, you would want your general partner to know the landscape. What are the investments that they find most attractive? What types are they missing out on? Who do they really find attractive? But they're going to know that universe better than anybody else. And they're going to understand why they went after a certain investment, and they're going to understand why they passed a certain investment. But what you don't want to get into, whether it's at that company level or at the fund level, which we were focused on, is I didn't even know they existed. You don't want to have that conversation of, oh, I'm here looking at their fund 3 or fund 4 fighting for allocation because I didn't know they existed for the past 10 years. You don't want to get in that trap. You want to have your thesis and your portfolio construction and understand how much you want allocated to early stage, generalists that invest across multi-stages or late stage, and understand the different risk dynamics to that. Earlier stage are likely going to be more diversified, whereas later stages is likely going to be more concentrated, but it goes both ways. So, there are GPs that are more diversified in late stage and more concentrated in early stage. So really understanding the type of investing strategy that you have as a limited partner is really important.
Yeah. And seeing as you're in the business of predictability, hindsight's often a great thing. But with your experience, are there any specific markers that, have determined in hindsight the funds that are the most successful, and any kind of particular rare markers that you think are often overlooked?
Yeah. If we're staying at the venture capital discussion, what I think limited partners often forget is that venture capital should look different. At the end of the day, it's not investing in the same companies. If you're meeting only GPs that are investing in, the same top brands, whether it was earlier or later, they don't have a differentiated sourcing. And so you're limiting your possible upside by only backing, forgive the term, name brand venture capital firms. You should be looking for venture capital that has different sourcing, different portfolio construction, just different theses. That is what venture capital is. It's meant to be different. So I would say that people need to keep that in mind. If they're, looking over someone's pitch deck or have a meeting and they say, yeah, we've co-invested with these firms, and you see that over and over again, they're only co-investing with certain name brand firms. It's okay. What alpha are they really providing? Are they indexing, a broader VC universe, or are they really trying to drive returns?
Superb. Thanks.
One of the things that you do with venture firms is improving their operational efficiency. How does that look in practice?
Yeah. I think operational efficiency, just in a word, is just smooth, right? You have individuals that are experts in whatever it is that they're doing, and so if you're asking a question, they've likely have the answer ready to go because they've thought of that. They're really thinking through the possible questions that might come up. and they're even thinking of questions that you haven't even thought of yet. So that's why I like investing in diverse talent. And there, and diversity can be different ways, whether it's the way we look or just background, and operations versus finance background versus former founders and things of that nature. All those different backgrounds make for a better, robust team. And so if you're only hiring people that look like you and have the same experience as you, you're not really creating a more robust team. And also, I mean, if you're only asking people to perform tasks that you give them, you're creating blind spots. So again, that's what I want to be able to do, is leverage my experience to minimize those blind spots. And the best firms have people who are not just doing work, but they're thinking ahead, they're anticipating challenges, they're minimizing, again, those blind spots, and to ensure that the firm can scale seamlessly.
Yeah, interesting. On the sort of portfolio company level, as opposed to the fund side of things, how deep does your involvement go sometimes with portfolio companies themselves and improving their performance?
My focus so far has been at the fund level. I'm happy to be helpful at the portfolio company level, and I would say that's more in being a help to the general partners and overseeing those companies. What I would say is that I know my lane. My lane is focusing on the fund level and being a partner and helpful to the venture capital GPs. And so I'm happy to gain that experience, and certainly leveraging my background as a CPA and underwriting co-investments, I do have a certain level of being able to help them in that regard. But I would say it's more being eyes and ears for the GP rather than me making investment decisions or things of that nature. I have provided advisory support at portfolio company levels, and I'm happy to do that as well. So yeah, it's my focus recently has been more at the fund level, but again, because of my background, I'm helpful at the company level as well.
Tony, when a company engages you, what does that typically look like?
It's understanding where they are in their process. Are they going from 0 to 1, 1 to 2, 2 to 3, and where I could be helpful in that regard. So that's where it starts off. I'm never looking to offer my services to a firm that doesn't need it. If they're, and I've had those conversations, and it's kind of actually, it's a bittersweet conversation. It's bitter in that, I'm losing an opportunity to help someone, and it's a really good firm, but it's sweet because they're doing everything great, right? I mean, it's not something that I can really add value to. So I try to be cognizant of that ahead of time and say, hey, I don't think you need my services, or if you're looking for a certain type of service, I'm happy to point you in that direction. That's not my expertise, or you could do it cheaper this way.
Mm-hmm.
So it's really just having a conversation, just talking to them, learning about their fund, learning about what they are looking to accomplish, and if I can provide value to that GP.
Yeah. What are the kind of main problems that are, the perfect fit for the work that you do?
Yeah, I would say one, going back to an earlier comment, is I'm leveraging my experience to mitigate or minimize their blind spots. So hopefully my experience differs from theirs, where I can use that experience to help them in communications. But really, at the end of the day, what I'm trying to do is help them attract LP capital, and that could look very different. So let's take an example of, a firm that has raised their fund one. They should immediately start thinking about their fund two. And it's not completely looking at fund two. It's taking care of your fund one portfolio in a way that puts you up and sets you up for success in fund two. So your current LP base is going to be your greatest ally when you go to raise your fund two, because one, they are hopefully going to write you bigger checks. And then two, they're going to leverage their network, and they're going to be telling other limited partners about what a great firm you are. So being, not just doing the back office and kind of overseeing, the non-investment functions, and but it's also about again, communication to the limited partners. And so let's have quarterly calls. Let's have memos that are not, you can put in your data room, and you can also, give those quarterly letters, but let's also make a brief summary. So those LPs that don't have time to read a 20, 30 page document can easily see what it is that you're trying to convey in 1 or 2 pages. And so just being able to help them do all those kinds of things.
Yeah, you kind of touched on the blind spots is, something we all have. The kind of hardest thing about blind spots is it's usually outside of one's awareness as well. So I'm just curious to find out, what are the typical blind spots that you find, that you're moving into and helping cover for the people that you're working with?
Yeah, I think it revolves around, what I'm trying to provide, which is, a potential blind spot is not understanding that you really need to make an ally of your current LP base, and understanding that if you are transparent and you're open and you're authentic to your current LP base, that is the best way to be. I've never come across a GP that has said, you know what, I've been transparent to my LPs, and they're like, hey, hold back on this information. I don't really want to see this. It's really the opposite. It's, I've been an LP in this fund. I never hear from them except for, the annual audit, and we may have an AGM, and when I ask questions, they're just, more focused on, other things than talking to me. So we got to remember about the partnership aspect of general partners and limited partners, and understand, and it's a two-way street as well. So limited partners need to understand they are limited partners. They are not a general partner. They should be passive. They could certainly talk about their strengths and weaknesses of, that particular fund, but they shouldn't have a handle in how it is that they're running their fund. You either invest in a general partner or you don't, but you don't change them. And that's, a dynamic. And I know your question was more on the blind spots, but that is a potential blind spot, is that there are general partners that are too open to limited partner input, and they deviate from their true self. And then, limited partners will often guide them to say, yeah, we think that you should, take risk off the table, or you should be investing in these companies or something like that. And that gets in GP's head, and then they change their strategy, and it becomes what you don't want it to be, which is similar to every other VC fund out there. Again, you want to keep that differentiation component to your fund strategy.
Got it. Thank you.
You'll have worked with a lot of GPs across your time in the VC and capital world. How can general partners stand out in today's crowded market?
Yeah, and maybe I'm emphasizing it a bit too much, but it's really focusing on being authentic. It's one of the most underrated traits out there. There are so many people, so many GPs that are focused on closing deals and converting meetings that what they forget is that if you're just relaxed in yourself, the whole process becomes easier. You're not putting forth a persona that is not your true self. Going back to, a previous question as well is, talk to LPs all the time, not only your current LP base, but LPs that prospective LPs outside of the fundraising timeline. So building those relationships and really being accessible to those limited partners is a huge advantage in this crowded market. So LPs invest in people. So again, being your authentic self is the best way to gain their trust. I mean, that's really because I won't go into differentiation as far as portfolio construction or strategy and things of that nature. It's really more qualitative in nature rather than quantitative, because everybody's going to be different from a quantitative standpoint.
Tony, you've mentioned authenticity and integrity quite a few times as well. I'm just curious to find out, why is that so important? There's the surface level elements of, obviously it builds trust, you have better relationships and that kind of thing. But is there a core value for you that it kind of speaks to?
Yeah, it certainly is. I mean, it's it's personal to me as well. So, I think that there is just too many people out there, again, putting out a persona that they think people want to hear rather than who they truly are. And again, I think it holds them back. Again, I want to encourage people to be different from a venture capital perspective and follow who they really are. If you're trying to, there's that old adage, if you try to make everybody happy, you end up making nobody happy. And so I think that's what gets lost, is we're not going to always make people happy. And being authentic, being true to yourself is going to be good for yourself, good for your mental health and things of that nature. But in the long term, it's really going to pay off from a fund strategy perspective, because people are going to be driven to people who are creative and who are authentic, and rather than just the status quo.
Yeah. And you've mentioned as well that kind of gender diversification consistently outperforms. Why do you think that is?
Well, so I've done some research on this, and I'd have to give credit to other people out there. But particularly at Harvard Business School, the research goes, and I'll end up butchering this because I again, remember, I'm a CPA. I'm not the best storyteller as well. So from a venture capital firm perspective, it was interesting. There was a study that was done a while ago, and it's called the daughter effect. I don't know if you guys have daughters, but when a traditional VC who is a male has a daughter, that senior VC is likely to hire women. And it's just because they see that as, hey, I want my daughter to succeed later in life, and I see the world through a different lens. You're doing this through a natural process. It's not being forced upon you. Nobody's saying, hey, you have to do this. You have to fill the status quo or something like that. You just see this naturally, and you're like, oh, I see the world in a different way. It's sort of like, when you have a younger son or daughter, and you see the world through their eyes, whether it's chasing a butterfly or, looking up at the clouds or something like that. It's really a beautiful thing. So the daughter effect, going back to venture capital, because there were so few women in venture capital, those men who have that daughter effect that are supporting women in their ecosystem are promoting women. Those women tend to outperform their male counterparts because they have, for lack of a better term, a chip on their shoulder. They have something to prove. And so you have inherently promoted a better candidate than a male counterpart. And you're doing this through a natural process. And so if you drive that through, that gender diversity, now that person has a different background and they're likely to support, for instance, diverse and women-led founders. Mm-hmm. And so they're likely overlooked by traditional venture capital firms and that kind of look like us. They're looking at, different opportunity sets. They're looking at different founders. It's a different sourcing mechanism altogether. So when you promote those individuals, that gender diverse team, you're creating a more robust investment environment for that firm. And again, going back to what I was saying before, venture capital should look different. And so you're doing that through a natural process. And that's why it's so important just to do it naturally, not forcing that diversity in any way.
Hmm.
I don't want to get too socio-political, but do you think that still has a big impact? Do you think it's still, there's sort of a conscious or subconscious bias in the VC world that makes it more challenging for, Black or Indian or women-led businesses to succeed? Because sometimes I'm asked that with the people I work with, and I'm like, honestly, I don't know because I'm not involved with the VC world. Is that something you still see, or is that fading out, or what do you think?
No, it's an interesting question. It's impacting them, I think, in an indirect way. And the indirect way is that there are less established firms that are diverse in one way or another. The firms, there are well-established firms that are very large and they are diverse, and whether it's gender or some other type of diversity, and they're getting funded. So I struggle to say that it's the focus of the diversity. It's really the focus on established versus emerging. And so they're willing to back people who have a very long track record and they've already shown success. But there are so few diverse firms that meet that criteria that the greater landscape suffers. There are more emerging managers and smaller managers that are diverse than not. And so just through, that lens, there was a term that I didn't really care for the past couple of years. They say it's flight to quality. And I would say that's a misnomer, or I certainly hope that's not the case, because it's really not flight to quality. It's flight to known, right? It's, hey, I know this brand. This is a household brand, therefore I'm going to support it. I don't know this new firm, therefore I'm not going to support it. And so you just have more of those newer firms that meet that diverse criteria that are suffering because of the macro environment. And maybe that's my rose-colored glasses view point, because I do think that people understand the outperformance and the opportunity set in supporting diverse teams.
Got it. One of the trends throughout the last 40 minutes of conversation has been the relationships between, managers and LPs and GPs and that kind of thing. You were talking about authenticity and transparency and that kind of thing. What advice would you give first-time fund managers about building trust and building that authenticity with limited partners?
Yeah, I say, going back to what I was saying before, I think it comes down to transparency, and I also think it comes down to being prepared. These two things go hand in hand. When you're your own worst critic, you've already anticipated the tough questions that limited partners ask, and don't shy away from those tough discussions. Identify and address those internally, and just prepare yourself for those questions. And so when you've done that work and compiled the data, and you should have everything that you need, and you don't have anything to hide. You've already internalized that data, and therefore you're not working on a defensive strategy. You're working more on an offensive strategy. Fear of sharing data is a major red flag for limited partners, or not knowing the data is a major red flag. So the more prepared you are, the more comfortable you are with sharing everything, the good, the bad, the ugly, that level of openness only builds true trust. There was a general partner that was more of a buyout strategy in my former life, and knockout performer. It was a very concentrated portfolio. I want to say they had maybe 10 investments. They had one investment that was struggling, and they had since turned it around. But they started off their AGM. The conversation was, hey, this is why this company is struggling. This is why this happened, and these are the steps we're taking to improve that performance in the long run. You're not going to like it as a limited partner, but we're going to end up having to hold it longer. We're going to improve it, and we're going to ensure that you receive your capital back. That was done without an LP asking a question. It was just, hey, this is it. And so I think taking that more offensive approach to your portfolio is a much better strategy than being overly defensive about it.
And I would assume as well that strategy, if we call it that, of being transparent and, not having anything to hide, not only will it have the impact of allowing LPs to trust you more, but it must also give yourself a level of confidence as well, because you're not faking anything, you're not trying to be something you're not, which also must come through and have a positive impact on the relationship.
Yeah, definitely. And I remember my days of underwriting funds, and I would have to present, and co-investments as well, and I would have to present to an internal IC and an investment committee in order to get their approval. And so I would make note of all the questions that were previously asked of whether the other fund opportunities or co-investment opportunities, and I would make it a point to address that the next time. So I know this individual is looking out for, this aspect of, the investment. Let me address that now. Let me, show them I've done the work to answer and possibly anticipate the questions that they're going to ask. And oftentimes that's going to lead you down a road of, oh, here's the second, third, and fourth layer that is involved with that question. And it just helps prepare you to better, again, convey those points to your limited partners. So yeah.
Any closing comments or questions, Finn?
I guess there's this one lingering kind of personal one. Something you mentioned earlier, Tony, about having daughters. And yes, I have one. She's 12. I'm presuming you have one as well?
No, I don't.
You don't have any daughters? All right, okay.
No,
no. My question was going to be, what can we do for the next generation of aspiring leaders? For anybody listening who want to encourage daughters to step up as leaders, what can we be doing for that generation?
Well, I think I'll answer it in a little bit different way. because I think the people that have daughters and the people that are supporting diversity in different ways are doing a great job of it. What needs to also happen are people that don't have diverse backgrounds. So I created a LinkedIn story on my page as well, if you want to take a look at it. But one of the things I think is again missing from schooling and things of that nature is just really putting yourself in the shoes of another individual. And so I'd written a story because again, I'm a white male that has, a heterosexual male that has one son. I've been happily married for 21 years. Nothing about me really screeches about promoting diversity. Yet I've always appreciated diversity ever since I was young, and that started in school, and the story I wrote about, talked about, a Dr. Seuss book called The Starbelly Sneetches. And so I don't know if you guys have read that in your youth, or, again, when you have children to read that, but really it's about, these Sneetches, this made up creature that lived together, and there were some that had stars on bellies and others that did not. And the ones that had stars in their bellies thought they were better than the plain bellies, Sneetches. And it was just, so they go through and, you have to read the story. And at the end of the day, not to spoil the story, but they realize, what the hell are we doing? It's not you're not saying that in a Dr. Seuss book, but that's the conclusion, is like, why were we so fixated on a star on our belly to determine whether we're better or worse than another individual? That has no bearing on it. So that's what I would say with diversity in any aspect. What makes you think just because of, your gender or identity or anything like that is, that you're better or worse than that person. You should really, again, want to dig deep into that conversation and really understand those individuals, because I think you'll find that those people are unique in a different way, and that's really why they're going to succeed.
Yeah, I think Dr. Zeus is more our generation, perhaps, and beyond. But thanks very much for that insight, Tony. Where's the best place for people to get in touch with you if they're interested in, just inquiring, or even a kind of diagnostic of where they're at?
Yeah, so I do have a booking button on my LinkedIn profile. They can also reach me at tony262m@gmail.com for my personal email, or for my work email, tony@alturacfo.com.
Excellent. I've just flashed that up on the screen there. So tony@alturacfo.com. Tony, thank you very much for being a guest today. It's been super insightful. Stuart, any closing questions or comments?
I don't think so. A lot of fascinating stuff in the venture capital world that I think will be very interesting and insightful for fund managers, LPs, GPs, and anyone else involved in that scene. So thanks a lot for joining us, Tony, and for the viewers and listeners, thanks for joining us as well, and we'll see you in the next episode.
Thanks for having me.